Hi, this is Adam Khoo here, and it's the 27th of June. The first 6 months of the year is almost done. So this is a quick video to talk about what has happened in the first 6 months of the year, how markets have performed, how I have performed in comparison, how some of my students have performed, and where the market is right now. So how do I look at the market, and what are the core positions I'm holding? What shares am I adding on to, and which are the ones which I'm not adding, or some of the positions I've actually cut out in the first 6 months. So if you're ready, let's take a quick look. All right, so on the chart here you can see the S&P 500 for the year to date, right? So the year started with the S&P somewhere at about 2004, and then we staged a very strong rally all the way to 2009, okay? And then May came about, and then I guess the curse happened, right? The sell in May, go away curse. And then the market had a relatively strong correction over here. And after the correction, we managed to reverse from the correction, and now we are finding that same level of resistance again, okay? If I zoom out even further, if you take a look at the 1 year time frame, let me just zoom out a bit more. There we go. So you can see that this level, which is about 2950, was the all-time high that was set previously, and it couldn't be broken. So the price went up and hit that same level of resistance. Sellers came in and pushed the price down. And if you recall, last month I did say that we could go all the way down to here or even retest the lows, okay? So at that point of time, what I did was I started hedging my portfolio. Normally what I do is, the moment I see the short-term trend going down, which is the 20 EMA crossing below the 40 EMA, I start to hedge about half my position by using put options to hedge my position. Remember, put options are kind of like insurance contracts which I buy. So when the market collapses, I get profits from the put options that will offset my short-term losses in my investment portfolio. And then if I see the 50 moving average crossing below the 150 moving average, or the market crossing below the 200 with the 200 moving average sloping down, I do a full hedge of my portfolio. Now that didn't happen. We didn't have a full-blown downtrend pattern. We had a short-term downtrend pattern over here when the 20 EMA crossed below the 40 EMA. And if you've been following my videos and my emails as my students, you know that I did half a hedge of my portfolio using put options over here. And when it went down, I took profits on some of my put options, okay, but I left the other half. And sure enough, it reversed back up again. Now, I thought it was going back down here or even over here. So the moment it reversed back up and I said, okay, we're going back up, what did I do? I quickly closed my remaining put positions and started to buy shares again. Started going long again, adding to my position to catch the wave all the way up. So a few lessons here. The first lesson is this: you got to be very, very flexible. Remember that no one can predict the future. No one can predict the market. No one knows where the heck the market's going in the next 1 week, 1 month, 1 year, or 10 years. No one knows, right? All we can do is make decisions based on probability. And what is more probable to happen based on reading the price action and the trend. And also looking at valuation. Is the market expensive or cheap, right? So as the market was coming down here and I saw that it was a downtrend, what did I do? That's right, I followed the market. I didn't argue. I took my put options to hedge my portfolio. But the moment the market reversed up, what did I do? I had to be flexible to say, okay, I don't think it's going down there anymore. I thought it was going down. It's not. It's going to reverse back up. So I quickly closed my put positions and I started to go long again, right? So in other words, I started to add more shares to catch the wave as it went up. So you could be really flexible as an investor or as a trader. That the moment the market reverses, you got to follow the market to where it's going. That's the key to it. So that's the first lesson here. Now, so what has happened in the last few days is we've gone up here and it looks like we have exceeded the all-time high by just a couple of days. Right? In fact, exceeded it by just about 2 days, and we form a bearish pin bar candle over here. Okay, bearish pin bar candle over here, and then the price started coming back down again. Now, the moment I saw that, I said, oh, I've watched this movie before, right? So resistance was hit, couldn't break the resistance, hit again, couldn't break the resistance, and now it looks like it may not be breaking out, right? It's reversing down. So what did I do? Well, I just bought some put options to hedge my portfolio. Now, here's the thing. Will it go all the way down, back to here, or back to here, or back to here? Again, I've got no clue. I've got no idea. I can't predict the future, right? But again, to buy a bit of insurance, I bought some put options over here. I'll show it to you in my portfolio in a while. Some put options to hedge my portfolio. So if the market does go down, I'm going to make some quick profits and use the profits to hedge my long positions. Okay? But if it doesn't continue going down, if this is kind of like a fake out, this could be faking out the shorts and breaking back above and flying, I'll quickly close my put positions and start adding more shares again. So I'm always very flexible, moving in and out really fast in the markets, depending on how I see the price action. So far, year to date, let me just show you again a year to date chart. Okay, so year to date from January to 27th of June, the S&P is up roughly about 16%. 16% year to date, right? So in general, my portfolios are up about 32%. So my performance is double the S&P, which is always my goal every year, to at least double the S&P. So I basically, every year in the markets, my goal is to, either double the S&P or get at least a 50% return a year, at least, right? If I can get that, my job's done for the year, whichever is higher. So this is one of my portfolios which I show my students. And you can see this was the last 1 month. We are up about 5.94%. So year to date, we are up about 31.67%. So about 32%, right? So I'm about double the S&P 500 for the first 6 months. So okay about it, right? Now the thing is, my goal, like I said, by the end of the year is to always get at least a 50% return. So I kind of like halfway home, but anything can happen in the next 6 months. I've got no idea what's going to happen. And the second lesson is this, that remember that your performance of your portfolio can't go up in a straight line. Nothing goes up in a straight line, right? It goes through ups and downs. So from 31% up, I could, go down to 5%, go up 30%. You have got no idea what's going to happen, right? In fact, before the May sell-off, before this May sell-off over here, the portfolio was up about 40%. Okay, so since that, I gave up about 10% of my returns because of this correction, which happens. It's part of the game, right? But as the market went back up, I've clawed back some of the gains. So in fact, if you take a look at this printout over here, you can see a clearer picture of what it looks like. All right, so this blue line is basically the portfolio, and the green line that you see, that's the S&P 500. So my performance is double the S&P 500, and you can see that, it was up about 40%, and then we had that big correction, okay, and now crawling up again, right? So hopefully can make it back to 40%, and then at least ending the year with at least 50%. Let's see what happens then. So what are my core positions that I'm holding in this portfolio? So over here you can take a look at core positions. Scrolling down, you can see you've got Apple over there, Amazon, Boeing, Alibaba, Bank of America, Facebook, FXI, which is one of the China ETFs that tracks the large cap China ETFs. I've got Alphabet, or known as Google, and GXC, which is another China ETF. I've got actually two China ETFs, GXC and FXI. Between the two, I prefer GXC because GXC, the ETF is more diversified. It's got a couple of hundred companies within that ETF, couple of hundred Chinese companies. And it's got much lower management fees. So why am I holding FXI? Well, I don't really like FXI that much because it's got less companies as an ETF and higher management fees. The only thing I like about FXI is that they've got more options which are available for me to sell covered calls on the ETF to collect more premium every month. So the options are more liquid. I get better price on the options. And that's the only advantage of FXI over GXC. I've got JP Morgan, 3M, Microsoft, the S&P 500 ETF, SPY. I've got Tencent over there, right? So you can see that for this particular portfolio, it's holding really great companies. Companies that have passed my 7-step value momentum investing criteria, that are great businesses, that I buy them at discounts to intrinsic value, and I enter at very good levels when the price is at a strong support level, especially when I see the price reversing into an uptrend. So that's when I accumulate positions in these particular companies. One of my strategies to ensure that I get at least a 20% return minimum on each of my stock holdings is to sell call options against my stocks. We call it selling covered calls every single month. So when I do that, I'm ensured that even if the stock market or the stock goes sideways or goes down, wherever it goes, I'll get at least a 20% return a year guaranteed. So let me give you an example. So if you take a look at Bank of America, you can see that I sell call options every month against my stock. Okay, so I just sold a couple of 6 call options against my 600 shares. And you can see that for each call option that I sell, I'm collecting 52 cents per share, right? And I'm collecting 52 cents in premium out of the share price of $27.91. So what that means is that every month I get 52 cents roughly out of $27.91. And the options I sell expire in about 30 days. So if they take 52 cents divided by 27.91, that's about 1.8% return that I get in 30 days, which is about 1 month. Okay, so by doing this every month by selling call options, I basically multiply that by 12, and that's about 22.3% return a year on my Bank of America shares. So it's a no-lose situation, right? So when I sell call options against Bank of America, in this case, you can see Bank of America right now is at $27.91, and I'm selling the call options at a strike price of $29. Okay, so if I show you the share price, look at Bank of America. Okay, so the current price is there. We are now at $27.91. That's the current price. Okay, so I'm selling call options at a strike price of $29. All right, so by selling call options, I keep collecting premium. I get 1.8% return per month, 22% return a year in premiums. Now there are 3 scenarios that can happen. Scenario number 1 is that Bank of America, keeps going sideways. It doesn't get above $29. It goes like that or goes down. Guess what? I keep the premium for free, right? Essentially, I get the full premium, right? Now, if Bank of America goes above $29, what happens? Okay, then I will have to buy back the call option which I sold at a loss, right? So I have to buy the call back at a higher price than I sold it. So I'll lose money on the call option, but I'll make more profit on the share price than what I lose on the call option, right? The profits gained from the 600 shares I own exceed the loss I make by selling the call. So net, I'm still making a net profit. So whatever happens, whether the price goes sideways, goes down, goes up, I'm making money. So as long as you write call options on fundamentally good companies that you know will go up eventually, it's a no-lose situation. It's a win-win-win situation. So that is one of the strategies that I use to ensure that whatever stock I own, I'm getting at least 20% return a year wherever the stock price goes. Now, for those of you who have no idea what options are or how to sell call options, you can check out my YouTube videos. Just go to YouTube, type Adam Khoo options. You can watch all the free videos on how I use options to hedge my portfolio, to generate extra income every month, and so on and so forth. And of course, you can also take the professional options trading course, where I go into depth teaching you everything you need to know about how to trade options, together with my good friend Bang Pham Van, who is our in-house options specialist, right? So besides selling call options, for example, again, Bank of America is right now at $27.91, right? So I'm selling call options at $29 to collect money, to collect premium, correct? Now at the same time, notice there's a strong level of support over here for Bank of America, because Bank of America is going sideways, it's in a range, okay? And in the long run, I can tell you that bank stocks, JP Morgan, Bank of America, will go much, much higher once interest rates start to rise. They have to rise eventually. Right now, because of pressure from the Trump administration and because of low inflation, the Federal Reserve can continue to hold interest rates or even cut them in the short term to less than 2%. But we know that eventually interest rates will have to rise once inflation comes in. So once interest rates rise, bank stocks will fly. So in the meantime, bank stocks are going sideways, so it's a great opportunity to buy bank stocks. And while they're going sideways, instead of sucking your thumb and not making money, you can make extra income by selling covered calls on your bank stocks to get at least 30% a year return. Now at the same time, if the price goes down again to a strong level of support, guess what? I want to buy even more Bank of America shares. I have to keep adding more and more shares every month, right? So instead of waiting for the price to come down and buy more shares, what do? That's right, I sell put options at the strike price of about $27, right? I sell put options at 27, I sell call options at 29. So what happens if the price never goes down to $27? I sell the put options, I collect premium for free every month again. That again adds to my return, okay? If the price goes below the strike price of my put options, I'm obligated to buy the shares at $27, which is what I want to do anyway, right? So a win-win situation. So I get to buy the shares at $27, I keep the premium of selling the puts. It's a win-win situation. I cannot lose in this scenario because I've done my homework. I know that these companies will go up eventually, but in the short term, they're going sideways. So you only do this for fundamentally good companies where you've done your fundamental analysis, that it pass all the required steps. So for example, you can see over here, under Bank of America, you can see what I do, right? So I've got the shares over there, I've got 600 shares, and I'm selling the call options to collect premium, 52 cents per share I'm collecting every month. At the same time, I'm also selling put options and collecting 31 cents in premium every month as well. So I'm earning both ways, and wherever the stock price goes, I'm going to benefit. And these are how professional investors make consistent income even in a sideways market going nowhere. So you can see that I use the same strategy for all my other stock positions, right? So for example, Apple, you can see I'm selling the Apple call options, collecting about $5 in premium per share every single month, right? For Alibaba, you can see over there, I'm selling the call options, collecting again $4.69 per share in premium, and so on and so forth. Right, so that's how I earn extra income on all my stock positions. Now, then the question is this: okay, but what if the market crashes? What if it goes down? Aren't you going to lose money on all your investments? Remember, when you buy great companies, you know that eventually it will go higher, but it could go down temporarily because of a short-term downtrend or bear market. But it's fine because it's going to go up eventually anyway. But having said that, we do not want to suck our thumbs as it's going down and seeing red in our portfolio. We want to be making money as the price goes down temporarily, and then use the short-term profits to then buy more shares before it goes up again. So the moment I see a downtrend pattern, right, I see that the market's reversing to a downtrend, what do again? I buy put options, which are like insurance contracts that will pay me as the market collapses. So like I told you earlier on, when I saw the S&P 500 That's right, okay? So when I saw that the S&P 500 kind of like hit that resistance level and started to come down, I said, all right, the price could be coming back down to here, or maybe back down to here, which I don't think it would, but who knows, right? So again, the fire's coming to your house. You don't think it's going to reach your house, but you just better buy some fire insurance. So in case it hits your house, the insurance company will pay you a lot of money. So I'll make a lot of profits if the market collapses. If the market doesn't collapse, then my put options will expire worthless and it's fine. It's kind of like you buy fire insurance, you pay the premium. If your house doesn't burn down, you don't get angry and say, darn it, I paid the premium for nothing, right? It's fine. It's a cost of doing business. So you can see that, I started to buy some insurance on my portfolio over here. Just bought it a few days ago. Where did I put it? Yeah, there we go, right? So I bought the 292 put option, right, about 10 contracts. So by buying this put option, it insures my portfolio, right? So with this put option, I've got the right to sell my shares in the S&P 500 for 292. That's the strike price, 292, okay? So even if the market goes down to 290, 280, 250, I have the right to sell it at 292, okay? At the same time, I buy another put option at 285 to generate some income to pay for my put options. We call this a put spread. And again, these are things that we teach in our advanced options trading course. And again, you can get some idea by watching the free option videos online. First, if you want to learn this stuff, it's really cool to hedge your portfolio. So no matter what happens, the market goes up or down or collapses, you're always making money. Question is only how much money, all right? So with that, let me now run through each of my positions to talk about where I see these individual stock positions going in the near term to the future. Let's take a look right now. All right, so let me start off with the FANG stocks, F-A-A-N-G. So we call them the big tech stocks. So these are the stocks that you have to own in your portfolio. It is a must. For a very simple reason, these companies dominate every part of our lives. So if you don't know what are FANG stocks, F-A-A-N-G, F stands for Facebook, you gotta own Facebook. A stands for Apple, the other A stands for Amazon, Netflix, and Google. Now bear in mind that out of the FANG stocks, the only stock that I do not own is Netflix, because I don't feel that Netflix has got a very sustainable competitive advantage. It doesn't have a very strong moat. It is now going to face a lot of competition from other video streaming companies. So, for me, I'll never touch Netflix. To me, it's not strong enough a business to protect it from future competition. So I'm never going to have Netflix, right? Now, as for the rest of the FANG stocks, right? So I've got Facebook, which I love, and I think that Facebook's a great company. Apple. Now, Apple, I've got half the position compared to other companies, because what I don't like about Apple is it's losing its market share in its iPhones, its iPads, it's all slowing down. But I'm still holding a bit of Apple because I think that it's now growing its services business in music, video streaming, and so on and so forth. So I still have a bit of faith in Apple, but not as strong a faith as compared to Facebook, Google, and Amazon. So my great confidence is in really Facebook, Amazon, and Google. These are the three main ones. Apple, I've got half a position, and I've also got a lot of faith in Microsoft. But the reason I've got a small position is because the darn thing is so expensive. I've been waiting for it to come down. It won't come down. I've been selling put options, collecting money on my put options, but the darn price won't come down. So I couldn't buy more. Damn it. So I'm hoping Microsoft would have a bigger drop so I can add more shares in. So let's take a look at these big tech stocks in my portfolio to begin with, right? So first and foremost, let's look at Facebook, right? Now, as you know, if you have been following my videos now, you know that since a year ago, I've been very bullish on Facebook. And I said, because of the data scandal, Facebook has been really undervalued. It's a great company. You got to accumulate Facebook. It's going to be much higher in the future. And now, of course, you know, Facebook is going full crypto with their new cryptocurrency. Is it called what? Libya or Libra? I haven't checked it out. But anyway, so I think Facebook is going to fly to new heights. So every time I see a bit of weakness in the stock price is making a correction, I keep adding more shares as much as I can. So let's take a look at where Facebook has come from. Let me just look at this chart. Okay, so this is the 3-year chart of Facebook, and you can see that it went on a very, very strong run, and then we had the data scandal, right? Facebook was being sued for, leaking data and all that rubbish, and it went all the way down. So this was a great opportunity. But of course, we never buy on a downtrend, right? Because downtrend, low can get lower, cheap can get cheaper. We always wait for a reversal of the trend to start buying Facebook shares. And I talked about this in many videos, so go check it out. So I started accumulating Facebook shares at this point over here, right? Why? Because you can see that the downtrend started to reverse into an uptrend. Very obvious. When you see from making lower highs and lower lows, the price started making higher highs and higher lows. So the moment I see higher highs and higher lows, and I see the 20 EMA crossing above the 40 EMA, as well as the price crossing above the 50 moving average, that is the first time I start to add shares. And the moment the 50 moving average crosses above the 150, I add more shares. And then we had a bit of a resistance with a breakout here. I added even more shares over here. So I was adding shares all the way. All right. And then we had this big scare that took out a lot of people. And at that point of time, I just held on my shares. It bounced off the 200 moving average. As you can see, I added more shares there. And now we are here. Okay. So at this point, we are now at $187 on Facebook, right? So people have been asking me, would I continue adding shares here? Of course. 2 reasons. When I add shares, I look at 2 things. Number 1, fundamentals. Is it still below its intrinsic value? Okay. Number 2, based on technicals, is it on an uptrend at a support level or at a breakout point? So first of all, let's look at fundamentals on Facebook. Let me see where I put my, over here, okay. So Facebook, okay. So based on my intrinsic value calculator, as again, those of you who have taken my value momentum investing course, you get this calculator and I'll teach you exactly how to put in the financial numbers to calculate the true value of the company. Because once you know what the company is really worth, based on its cash flow, based on its debt and assets, you have absolute confidence to buy the company. And no matter where it goes in the short term, no worries, because you know what it's really worth. Remember, in the short term, the stock market is emotional, it's irrational. Like Buffett says, in the short term, the stock market is like a voting machine. Whoever is the most popular gets the highest prices. But in the long run, the stock market is a weighing machine, which means companies with the best value, that make the most money, have the greatest assets, will eventually command higher prices. So the intrinsic value calculator tells you the true weight of the company, how valuable it really is. Okay, so you can see that based on the intrinsic value calculator, Facebook has an intrinsic value of $226 per share, which means that anything below 226, it's undervalued. It's a great deal. And right now, selling at 187, we are still very much undervalued, right? Now, you can see that currently we are on a clear uptrend, right? We're still on a very clear uptrend, and the price is not yet overextended. It's still pretty close to your 50 moving average. So yeah, this would be an opportunity to keep adding more shares at these levels. All right, and yeah, I've got absolute confidence that it's going to definitely go to 220, which is the intrinsic value, and probably break above that in the next couple of years, because the intrinsic value will rise over time as the company increases its earnings. All right, so my near-term target is 220 for Facebook. All right, again, this is not an advice for you to buy. I'm not a licensed financial advisor. I'm just a humble investor that tells you how I invest, and you should never follow me blindly. You should always do your own research and your own homework. So let me just make it clear, it's not a recommendation. I don't recommend stocks. I don't make advice. I just tell you what I do, right? And purely for educational purposes. Facebook. All right, now let's look at Microsoft. Microsoft is a great company, but it's bloody expensive, man. It's bloody expensive. It's overvalued, but I love the company. I'm waiting for it to come back down to a lower level to buy more shares. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.